The price of gold has been in focus after the US recorded the fastest growth in inflation in over 3 decades. We have seen that gold has broken out above its 15-month declining trend line. Remember that in December last year it had made a high, and then earlier in the year it had made a lower high, and currently, which is $1,850 to $1,860 an ounce, that is where the breakout point lies for gold. And we have risen about 10% from the 52-week low. Not only that, gold prices are up about 4% for the month itself, and interestingly, gold prices are also on track to gain approximately 2%. Not only for this week, but previous week also we managed to gain about 2%. So definitely some upside momentum that is kicking in for gold prices. One has to also remember that gold is generally bought as a way to protect wealth when consumer prices are on the rise, and that is exactly what we are seeing on the cards, with 1850 to 1860 being the key make or break level, which is gold prices currently trading near the falling trend line resistance. In case we are able to sustain above those levels, then there could be a big breakout on the cards as well for gold prices. Not only that, even silver prices are on the rise. In fact, for this week itself, price of silver is up more than 4%. So both precious metals doing exceedingly well as far as the short-term trend is concerned. But if you have a look at what impact this has on the equities basket, that is the more interesting one, because what we did was plot a ratio chart of gold price versus the S&P 500. The current ratio stands at about 0.4 times, which is at the lowest level that we've seen since 2005. If you have a look at the 50-year average of this particular ratio, that stands in excess of 1. In case we are about to revert to mean, which means that it could have a positive impact on gold prices, and that could act negatively or against equity prices. Let me just highlight some figures for you. 2000 to 2002, when this ratio was at a subdued level of 0.2 times, we saw that during this period the S&P 500 managed to decline more than 40%, and then once again in 2008 to 2010, when this ratio was at a subdued level, we saw that the S&P 500 managed to crack more than 40% once again. So definitely some signs of caution that would be warranted as far as equity holders are concerned, because on one hand you have the price of gold, which is on the rise, the dollar index also touching a 95 mark, which is the highest level that we have seen since July 2020, and that of course does not go very well for emerging market equities like India. And in the last few days we have seen a sharpish correction come in for the Nifty as well as the Nifty Bank. The maximum drawdown that we've hit this time around is about 4 to 5% for the Nifty from its all-time high level, and for the Nifty Bank it is in the range of about 8 to 10%. So at the moment nothing to worry about, but this particular ratio should definitely be watched out for, and the price of gold also above $1,850 to $1,860 an ounce should be on the watch out for. In case that happens, we could have a big rally on the cards for the price of gold.